The look at Barloworld. Last month, the Barloworld Automotive and the Maponya Group opened up a R30 million Volkswagen dealership in Soweto. This venture comes only 3 months after the joint partnership opened up a R40 million Toyota dealership in Soweto. Barloworld closed today with a market cap of R22 billion. Paul, let's start off on the automotive side, I suppose, of Barloworld, which is just part of the group. What do you make of their focus on the emerging market, middle class in South Africa moving into Soweto?
I like that story. You know, the motor vehicle trade, we know, is viciously cyclical. So I think that's one of the key things we've got to talk about tonight is, you know, how does one invest in this space? We know that we're in a car-obsessed country. Everybody loves cars here. And we live in a country where everything's far apart and the public transport is a bit mixed. So if you can afford it, possibly in your life, you're going to be a car owner, and that means, you know, obviously opportunity to resell entry-level vehicles. But there's also a very impressive luxury goods, luxury car market here. I remember a stat from years ago which said that there are more BMWs as a percentage of the total vehicle fleet in South Africa than in any other country in the world. So it puts it in perspective. Barloworld, one of the big players in there. Barloworld, though, obviously also a major player in the automotive, the earth-moving and heavy equipment area with the Caterpillar franchise in Iberia, which means Spain, Portugal, Siberia, and also Africa. I suppose there's an automotive theme there too, and again, it's an issue here of how well they do when the going is good. They do extremely well, and the margins fatten and everything looks fabulous. But when the going is not so good, then they can suffer severe retrenchments in their profits.
The ultimate cyclical stock, some might say, really evident in their earnings. Profit before tax in 2007, R2 billion. Profit before tax in 2010 fell to R528 million and recovered to R1.6 billion. Huge swings there. What are your views on the cyclical nature and the exposure to the construction industry, the mining sector?
Yeah, look, it's one of those companies you want to buy. After it's unbundled, it's PPC, we're probably one of the more steady dividend payers and income stream earners for them. It's certainly exposed totally to the cyclicality of some of those industries. We think that they're actually going to bring out better earnings this year, so that P that's currently about 20 is going to come down to about 12. So probably fairly priced where we are in the cycle now. There is a bit of headwinds now from still in the construction space, but then also I think the mining boom that we had over the last 2-3 years is probably a bit slowing down at the moment. I'm not too negative on it, so I think most of it's priced in some of our diversified miners. But certainly I think the new orders are probably going to slow down going forward.
Their order book was looking pretty healthy at the end of the December quarter, sitting at R6 billion. That's from the September quarter, where it was R5.2 billion. But that on the back of the mining sector and demand from mining houses. Your views on the exposure to the mining sector and the fact that their earnings are riding on a recovery there?
I'm very positive about that because we're big investors in commodities, we're big investors in diversified miners. They are precisely the people that buy all of that stuff. You know, if they're developing a major new copper mine in Zambia, then it's Caterpillar equipment which gets bought, and you know that, you know, they have associated mechanical equipment which Barloworld supplies as well. And, you know, we own Caterpillar, the parent company, in our US portfolios for clients, and it's got a similar profile. People say, oh well, it's doing well globally, but it's doing very badly in construction activities in the US. Next thing you look, they're opening a new plant in America because you can't get a back actor in the US for a housing construction project until 2014.
Exactly. They actually highlighted the fact that their problem this year would be the fact that Caterpillar lead times were increasing and they were struggling to actually meet the demand from the mining houses. So if that's their biggest problem, then you've got to ask, you know, whether they are such a risky player.
Yeah, sounds like a good story to have. But the problem here is the earnings. I mean, as you pointed out, let me talk about it in earnings sense. In 2007, they made about 12 rands a share of earnings. The share briefly traded at 180 rand a share. So things were looking great. Now we come back, beg your pardon, that's the wrong price. Now we come to a point now in 2012 where the earnings are estimated to be, you know, around 7-8 rand a share. And as Gerbrand says, the earnings are looking more realistic in terms of the share price. You can understand why that's going. But we have moved in this Last calendar year, Barloworld has traded between 58 Rand a share and 100 Rand a share. That's a massive movement.
Huge movement, yeah.
It's just too crazy, and you can't really tell where you are in the cycle. So there are one of two ways of owning Barloworld. Either you must just own them and forget about what the share price is doing, understand that they're a cyclical stock, and own them for the dividends and just take them on a 5 to 10 year view, or you've got to try and trade the cycle.
So hot or not, just under 100 Rand, 96 Rand, where it closed today.
Too wild for me, sorry. Too wild, too much potential to disappoint clients by owning this one.
Gerbrand, your views, and also highlighting the fact of the vulnerability of the business right now, given the exposure to Spain, Portugal and the likes in the Eurozone.
Yeah, look, I don't think that's a huge exposure for them. I think the Southern African operations is much better, and if you look at growth in Russia, it looks very interesting, and some of the other bloc countries there. But certainly, I think from a normalized headline earnings per share, to take the margin of safety out, what we like to do as fund managers, is certainly looking a bit rich as where it is at the moment. So you're looking at about 7 or 8 Rand, like Paul said. It's P of 12, 13, which is fine for a company like this. So we would say it's fully priced, and we would be looking elsewhere.